Welcome to my channel, Finance Architects. Did you know emotions can significantly impact your financial decisions? It might seem surprising, but it's a fact that fear, greed, and regret aversion play a pivotal role in the choices we make regarding our finances. Imagine this: the market is bustling, shares are soaring, and everyone is jumping on the bandwagon to invest in a particular company. The lure of quick profits is strong. That's greed at play, driving people to buy overvalued stocks with the hope of making a fast buck. But what happens when the tables turn? The market takes a downturn, and suddenly, those same stocks that were the hot topic of conversation are now plummeting. That's when fear takes the driver's seat. It can cause panic selling at low prices, even though that means locking in losses. These emotional reactions often lead to a counterproductive strategy of buying high and selling low, a far cry from the optimal strategy of buying low and selling high. Now let's talk about regret aversion. This occurs when individuals sidestep making decisions that could result in regret. Picture holding on to losing stocks merely to avoid admitting a mistake. This regret aversion can result in clinging to poor investments longer than rational analysis would suggest. So, what's the takeaway here? Emotions are a part of us, and while they can enrich our lives, they can also lead us astray when it comes to financial decision-making. Greed can push us towards risky and overvalued investments. Fear can make us sell when we should be buying, and regret aversion can keep us stuck in bad investments. To make sound financial decisions, we need to recognize these emotional influences and strive to keep them in check. In the world of finance, it's not just about numbers and graphs. It's also about understanding the human mind and its emotions. That's the fascinating field of behavioral finance for you.